All right, hello everyone, it's Minik, and we are going to talk about the title P&L. So, the big three. We have financial statements that are important to understanding our company and also to understanding if and when we're going to publish a title. So, the big three are your income statement. This is also called Profit and Loss Statement or P&L. Income statement, this is incoming and outgoing money for your business, so income statement. The other is balance sheet. Balance sheets are about understanding the money that is contained in your business or how things are balancing out in terms of your assets and liabilities, money that you are owed and money that you owe other people. And then we have cash flow statements, which are really about how money flows through our company. And for publishing houses, because you have big upfront costs for printing and manufacturing and shipping your product, and once those books are sold in store, the stores have 30 days, 60 days, 90 days to pay their bills. Cash flow is an important thing to understand for publishing because oftentimes publishers are acting as banks. They're sort of financing the industry when in fact they're not banks and they're not able to charge interest rates the way that banks do. So understanding cash flow is an important thing. So I want you to take a deep breath and maybe think about cute kittens or rainbows or puppies. I like this little kitten. He or she has obviously surrendered to the beauty of financial statements, totally unguarded. And this is the mindset that you need to bring to financial statement analysis. Don't worry and start thinking, I can't do math or I don't understand spreadsheets. You need to remember that stories are important, both in terms of marketing communications and management and leadership, but most important are the stories that you tell yourself about what you can or can't do. It's that pesky reptilian brain who's responsible for fight or flight that you do not want to engage. You don't want that limbic brain your thinking mind, having to calm down that reptilian brain and say, no, 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 it's fine. You want to create space for the limbic brain to do its job. As soon as you start worrying about screwing up, it's that little voice in your head focused solely on survival that distracts your mind from performing the task. And this is documented research when 3 US universities looked at sort of worry. They understood that it undermines the short-term memory system needed for problem solving. And we need that problem-solving ability in order to look at financial statements because it really is about understanding the story behind the numbers. It's like being an investigative journalist or a forensic scientist or a police detective or a doctor doing a diagnosis. The numbers are symptoms of what is going on inside a company. So for publishing, most people are not becoming accountants. It's more likely that you're an entrepreneur, a publisher, an editor, or a marketer who needs to be able to understand the story behind the numbers in order to do things like more confidently buy a title, stay within a budget, or set that budget, and help the company remain solvent. So when you're approaching financial statements, especially that profit and loss statement, in your head you need to say, let's do it. Say it with conviction and confidence, like there's nothing in the world that you would rather do right now than look at a P&L. It's better than ice cream unicorns, kittens. So let's do it. Here is the basics of an income statement. There are two kinds of P&L statements that you might encounter. There's a title level P&L, which are used pre-publication to determine if a book can be published profitably. And then each book kind of has to stand on its own. So if you're publishing 10 titles a season, then the combination of those 10 T&Ls, along with some other metrics, of course, gives you sort of your company-wide profit and loss statement. And what isn't clear to non-accountants is the pattern and terminology that's used in these income statements. So it's really divided into sections. You have your top section, which is revenue. In publishing P&Ls, you often will see gross revenue. So this is the total amount that you made minus your returns and your bad debt, which gives you your net revenue. So this little section is sort of our first place to start. It tells us the sort of big numbers about what's happening within the company. The next section, the sort of manufacturing to project salaries, that gives us the total direct costs. This is really your costs and expenses that are related to manufacturing the title or manufacturing your products as a business. And there are two different types of costs that you'll encounter. There are direct costs, or costs of goods sold, or variable costs. Again, all the things that are related to manufacturing, rights and royalties, delivery, fulfillment, sales commissions. They're all directly related to the publication. And these numbers fluctuate. The more you sell, the more you have to print, the more you have to ship. So the costs go up in direct relationship to that. So direct costs. The next little section is basically what tells us, what do we have left to work with? What's our operating margin? So if we take our revenue, our net revenue, minus those direct costs, then we have our operating margin. How much do we actually have to play with? How much is left to cover our fixed costs? Things that we have to pay regardless, like our rent or the electricity bills, phone bills. These are all fixed costs because we have to pay them regardless of whether we sell our titles or not. So they're sort of fixed, or they're indirectly related to the thing that we produce or manufacture or publish. And then at the very bottom, we have what is really left before we have to pay our taxes. So that's our profit. So remember, unicorns, kittens, rainbows. Let's talk a little bit more about section 1. So revenue is that top line. When you're assessing a P&L, you want to start at the top and work your way down. So you want to look at that gross revenue minus the returns and bad debt to get your net revenue. These are interesting numbers just to look at on their own. But one of the things that you want to know or understand about publishing is that returns are a significant part of your operation. So anywhere from 25% to 40% may be an acceptable range for your publishing house within the book industry. So what you want to do is do some calculations. Look at that returns line, the 1 million plus. What percentage of our gross revenue, the 4 million plus, is that? So the story behind the numbers here, that percentage is going to tell you, is there something to worry about here, or are we within the standard for the industry? Are we within our own benchmarks for our own company? So you'd be looking back at your historical data. If it's on par with what you have seen before, you'll carry on down the spreadsheet. But if that number is substantially higher than expected, you're going to go back to your salespeople, maybe to your inventory manager. You're going to try to dig into, why are these returns so high this year? What has happened, and how are we going to counteract the effect of that? So here's that little section that you're talking about, and our happy unicorns, because spreadsheets are wonderful. So our second section here, section 2, which is related to your costs and expenses that are directly related to publishing or printing or manufacturing, whatever it is that you sell as a business. And when you're analyzing P&Ls, you want to calculate here the gross margin. So you're looking for revenue minus the cost of revenue to get your gross revenue. So your cost of revenue are all those direct costs, your COGS or your variable costs, costs of goods sold, again, the terminology is 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 quite esoteric for people who are not accountants. So you just want to be familiar with some of these terms so that you can understand what people are talking about. So the same way that we wanted to know the percentage of returns, we also want to know the gross margin as a percent. So, excuse me. So what we want to do is to calculate our operating margin or our gross margin or gross profit, we're going to take that 3.5 million minus this 2.3 million to get our 1.1 million, the operating margin. Right? So we're going to minus those two numbers. And then once we know what our operating margin is, we want to calculate this as a percent. So we're going to say 1,144,700 divided by 3,500,000. So basically, what is the story? We've got a 33% gross margin here. So that tells us a little bit about how we're doing, and it tells us what kind of business we have. Is it high margin or low margin? So some businesses have a very high revenue but very low gross margins. An example of that would be a low price retailer like Costco. The gross margins for a discount retailer could be as low as 25%. Right? They sell a lot of product, but the margins are very slim. So Thomas Wall says that most publishers are working on a gross profit of around 50%. So gross profit, gross margin. If we're at 33%, we need to look at how can we make more revenue or have fewer returns or reduce some of our direct costs in order to affect that gross margin. Right? Because when we're looking at these spreadsheets, it's not just about here are the numbers that have been puked out from some system. We need to put on our detective cap and really understand what are the numbers telling us. We want to do things like calculate these percentages and really look at, how does this compare to a previous reporting period? You're looking for big picture trends in what the data is telling you. So if gross margin is your net revenue minus your direct costs, then your operating income or your profit before tax is your net revenue minus all your expenses. So minus the direct costs and the indirect costs. This is going to give you your profit before tax. So the 3.5 minus the 2.3 minus the 800,000 is going to give you that final profit before tax. So again, you want to calculate the percentage here. Thomas Wall says that the average operating income or profit before tax or operating profit for large U.S. publishers is approximately 11.5%. There's usually some lines after this in a full P&L. You would have to take into account your interest and your taxes, and then that would get deducted from your operating income to give you what's left, your net income or your profit after tax. But for our purposes, we're going to stop here at profit before tax. So remember, spreadsheets can be really wonderful and provide this interesting insight into the conditions, the operating conditions for a company or for how a title may or may not perform. So they're really important to understand, and those are the top level lines that I always look at when I am first approaching a P&L.